The BT studio.
Thank you very much, Michelle. Yes, we are summing up our tax week with our friend Jim Yee. He is back with us here in the studios. Good morning.
Good morning, Wendy.
Now, we're talking about taxes this week at this time every day, and we've kind of gone over how to fill out a tax form, all those kinds of things, RSPs, and I think a lot of people are feeling the pinch this year because, of course, if you do have some money in RSPs or even just regular investments, they've taken a big hit in today's market, haven't they?
Yeah, I mean, I think, quite frankly, every year everyone's feeling the pinch. I think it's just the state of the world we're in. There's always something else to do with your money. Yeah, it's just a matter of discipline and putting it as a priority and getting your financial health in order, as we say. So yeah.
But there is an upside. Okay, so if you have invested and you think, what the heck do I even put my money in these days? I'm not making any money. Nothing's going right. There is an upside at tax time, at least, for having lost a little bit over the year, isn't there? It's called tax loss selling.
Tax loss selling, yeah. You know, when it comes to investing, the basic premise of investing is buy low, sell high. And what you'd want to avoid doing is selling low. But tax loss selling is probably the one opportunity where you can sell low and make it worth something. And the whole idea behind tax loss selling is selling an investment when it's down and using that loss and writing it off against an investment that might have done well.
Okay.
So that's the basic premise.
Who are the people who should be considering this as an option? What would be the ideal situation where you'd say, I should dump some of this and write off the loss?
Yeah, you know, what's very common today in this environment is there's a lot of people out there with second properties. Real estate's done incredibly well over the last 5 years, and a lot of people are sitting there saying, well, should we sell off our property? And then they get surprised when they do sell off the property, there's this big capital gains, right? So, so in those circumstances, if you have a second property that's done very well and you want to sell it, you can offset those losses with maybe something in your portfolio that hasn't done well, and your gains.
They roll it back in dividends, or
we call it unaccrued gains, right? And so they continue to gain. In that case, you would use the $10,000.
Okay, so in the first scenario, if you have claimed taxes every single year and it's now worth, say, $15,000, if your stock is now, or your investment is now worth less than the 15, if you've paid taxes, then you're at a loss.
You are
if
correct.
You've not paid taxes, it's your original investment.
You are correct.
Okay, but there's a lot of funny little things about this as well, isn't there?
The big confusion comes in the difference between what we call realized gains and unrealized gains. Mm-hmm. So if we use a mutual fund, for example, it started at $10,000 and it grows to $15,000. Well, there may be part of that $5,000 profit that you've paid tax on, because you get a little T3 slip every year that says, I've paid tax on some of this. But some of that gain will be unrealized. So that's why it's so confusing, and that's why it's important for people to get help if they need help. Yeah.
Now, in the case of someone who has sold a second property and really needs to reduce the tax hit from the capital gains, this could be worthwhile. But you have to evaluate that as well, don't you? Because ultimately, you don't want to sell low. You don't, you don't want to sell off. It could be an investment that, yeah, maybe this year it took a hit, but ultimately you hope you got into an investment that's good long term.
Right.
So you really would want to evaluate then whether or not it was worth selling off.
Yeah, and there are strategies around that because, for example, a very simplistic example, let's say you own a bank stock, and it's gone down just like everything else has gone down. But you really like bank stocks long term. Well, what you could do is sell that bank stock and then buy another bank stock. So at least you're still in the banking sector. Right. Now, it's important to understand that there's something called a 30-day rule. So when you sell your bank stock, you have to be out of that bank for 30 days. If you buy back within 30 days, then they can negate the loss. So the strategy would be sell the bank stock, buy a different bank stock, and then after 30 days you could buy back your original investment if that's the choice that you wanted. So at least you're in similar types of investments because they tend to move together anyway.
Jim, thank you so much for being here
You're
again
welcome.
today. And of course, we'll see Jim in the future as well, because he's always here helping us guide through the chaos that is our finances. Wealthwebgurus.com is Jim's website, and he's got a lot of helpful information there. And once again, we just want to say, You do probably need some help from a financial advisor for this one, but it's just a strategy if you find yourself with a huge tax bill this year that's worth investigating. At least we've given you the questions to ask, so when you go to your advisor, you'll have a place to start. Thank you for being
for having
great
me.
to see you. Let's go out to Bridget Ryan right now. I believe she is doing a little synchronized swimming this morning. Hey, Bridge.
Hey, Wendy Sandwith.